Donald Luskin, let me start with you.
Okay.
Ben Bernanke, inflation gunslinger. He did not go to a neutral statement. He maintained his inflationary bias. What is your thought?
I think he played this one like a violin. Now, admittedly, he was playing that violin coming out of a train wreck that he himself was complicit in creating, but he did this thing exactly right. And the proof is the stock market, which is basically unchanged at the end of the day from when the FOMC announcement came out. He did it exactly right. He didn't bow down and promise the bond market that he'd bail out all their profligacy. Neither did he disappoint the inflation hawks by easing off on those concerns. I have to say, under tough circumstances, I think he got it right.
Why do you say he caused the train wreck? I don't get that at all. I mean, Bernanke a year ago predicted a soft landing, which we've had, which included a terrific stock market. He also predicted declining core inflation rate. I mean, if anything, I think this guy Bernanke has been absolutely right on the money.
He certainly has with respect to the overall economy. I absolutely agree with that. The train wreck I'm referring to is in the credit markets. The Fed has been too easy for too long. They've created a credit bubble, which is very rapidly unwinding and causing a lot of risk in the unwind. I think it'll be fine. The train will get back on the rails, the credit train, and it's not going to damage the overall economy. The whole rail yard is going to be just fine. But this credit crack-up is the Fed's problem because they stayed too easy for too long.
All right. Wayne Angel, welcome back. You have been calling for a reduction in the federal funds rate. You are very worried about the housing deflation and the housing-related, mortgage-related credit deflation. I want to ask you about Bernanke, but I also want to ask you about what Don Luskin has just told us, that the Fed has been too easy for too long. What's your take?
Well, certainly the Fed was too easy from 2002 to 2005. There's no question about that. And what I want to point out is that too easy a stance had an impact upon housing that was delayed by 2 years. So there's a huge delay between taking the target Fed funds rate to 1% and generating a housing boom. But there's going to be a 2-year delay on the other side. That is, we're going to need to have interest rates are going to need to accommodate towards where house prices will be 2 years from now. And this is a 3 to 5 year house price downturn, not a 3-month downturn.
So you would have preferred them to drop the funds rate today?
I would have preferred they drop the Fed funds rate today. I would have preferred, first of all, that they go to a neutral directive in May.
Right.
So to set the stage, it would have been a little bit out of step for them to drop the Fed funds rate today. Clearly, they would look like egg on their face, but the sooner they get around to dropping the Fed funds rate, the better the chance we have that this housing event we're in is not prolonged into a general deflation. The strange thing is that the Fed, including Bernanke as the governor, they really got too easy back in 2003 when there was no deflation. But now that we've got this disinflation and deflation in house prices, they don't seem to see it.
All right, so Bob McTeer, you wanted a neutral statement last time we talked, which was, what, on Friday evening with former Fed Governor Larry Lindsey. You didn't get a neutral statement either, so are you roaring angry at the Fed?
No, from the Fed's point of view, everything worked out fairly well. I agree with Wayne that they're a little out of step if they have to consider easing while they have a bias toward tightening. So I would have preferred a neutral statement today to give them more flexibility.
All right, but you know, you guys are, Luskin liked it, and the stock market agrees with Luskin. And in fact, the financials in the stock market, which in some sense are the absolute key part of the stock market, they agree with Luskin too. Wayne Angel didn't like it, so that put him at loggerheads with stocks. And you don't like it, but that puts you at loggerheads with stocks. How do we resolve this, pardon the phrase, conundrum?
No, it could have been better from my point of view, but I liked it fine. Let me comment on the Fed being complicit in this. 1% probably was too low, and it probably stayed too long, but the Fed started raising the Fed funds rate in June of 2004, and they went all the way from 1% to 5.25%. At the same time, the market is what kept long-term rates from going up. They actually declined a little bit during that period. The Fed was trying to tighten. It's the markets that kept long rates probably too low.
You were a voting member of the FOMC during that period.
In June of '04, I was still there. I left in November.
And you were therefore a voting member when they went to 1% on the Fed funds rate, which Mr. Luskin essentially blames as the font of all evil.
Right.
Did you feel guilty? How do you respond to Luskin and all these critics that are now blaming the Fed? It's sort of a retrospective, retroactive Fed blame game.
Well, I did find it hard to worry about the prospects of actual deflation. I thought that wasn't terribly serious, and if it did occur, we could get out of it. However, Chairman Greenspan was not concerned that it was likely, but concerned that if it did happen, it would be very serious, basing that, I guess, on the Japanese experience.
Well, do you feel guilty about this decision? Do you have trouble sleeping at night?
No. I don't sleep well at night, but that's not the reason.
All right, I don't want to go any further for this particular segment. Don Luskin